There are so many what ifs that, I mean, could all of these things happen? Welcome to the Impact School of Money, where our mission is to change the way that people are educated about money. I'm Adam Davis, your host, and this is episode or lesson number 5. We're going to be continuing our conversation on life insurance, but more specifically, riders on life insurance. If you're watching these sequentially, you would have just watched episode or lesson number 4. This is episode 5, and then if you go to episode 6, you're going to notice something possibly quite interesting. Is you're going to wonder how between episode 4 and 6, well, especially between episode 4 and 5, how I grew this amazing beard within like a couple of days. And then episode 6 you're going to go to, and you'll see that the beard is gone. So I'm actually talking to you from the future right now. When we started the Impact School of Money, episode 5 actually fell about the middle of September, and right now it is the beginning of March of the following year. So we actually broadcasted and created the content and originally broadcasted episode 5 back in the middle of September of 2018, and it is now the 7th or 8th, it's the 8th of March, 2019. So I'm actually talking to you from the future, but we needed to recreate episode 5 because we actually just launched our YouTube channel and the Impact School of Money website where people can watch different lessons categorized by what they want to learn about. And we noticed that as I went through and we were making these, that I didn't push record on episode 5, and so we're remaking episode 5 right now. Almost, what would that be? Almost around 6 months later. So the success of the Impact School of Money is incredible. So as you go through these lessons, it's actually kind of fun that this one kind of is actually falling in between episode 44 and 45 is where we are currently, even though you're watching lesson number 5, and the education and the value that you're getting and will continue to get is unbelievable. Just to talk to you from the future, we have almost 25 hours of free education that you get from the Impact School of Money, and the reach and the future plans and the momentum and the direction that we're going is just incredible, and you'll see that as you continue on with the Impact School of Money. And so today what we're going to be talking about, continuing our conversation with life insurance, is riders that are added to life insurance policies. And so also we're going to be covering the most basic form of life insurance, which is called annual renewable term, which all life insurance is actually based on. So let's start there. Let's start with annual renewable term, or it'll be shown as A.R.T. Okay, and I'm going to move this a little bit closer, just so it's a little bit bigger, get that glare out of the way. Okay, so annual renewable term, what does that mean? Well, like I've said before, the awesome thing about life insurance is what it is usually described in the title of the type of insurance. So annual renewable term means that it renews every single year. And so we have annual renewable term and we have level term. Level term is basically annual renewable term added up over a certain amount of years, divided by that many years, so that the person isn't paying an increasing premium, they're just paying a level premium the whole time. Because let's face it, as Americans, we like fixed payments. We don't like to have payments that change on us all the time. We like the more predictable payments. If you have internet, don't you just love it when Comcast or whoever you have in your local area, you get that promotional window of 6 months, a year, and then a year later, your internet triples in price. But then you don't pay attention because you've got it set up on automatic. Somewhere in the tiny fine print, it said it would adjust after 12 months, but we're busy, and suddenly 3 months goes by, and we've been paying $180 a month for internet that used to be $70 or whatever. And if I sound extra passionate about that, that actually happened to me like 3 months ago. We were paying like $80 a month, and then it was drafting like $175, and several months went by before we even noticed. So nobody likes those increasing payments, especially if it's kind of a surprise thing. And so annual renewable term is just that. So let's say, for example, I was going to get a $250,000 policy, and I'm looking at a level term policy versus an annual renewable term. A level death benefit, $250,000, let's say for 30 years. I'm 35 years old. It's going to go until I'm 65. $250,000, 35-year-old for 30 years. I'll probably be paying somewhere in the range of about, depending on my health, $25 to $35 a month, assuming I don't add any riders or anything like that, just a basic policy. I'm going to be paying $25 to $35 a month. Okay, and that's going to be the same for 30 years. If I was to do an annual renewable term, how it starts is it would probably start at about $7 a month. And then the next year it might be 8, and then 12, and then 14, and so on and so on and so on. But what's interesting is if you added the total premiums, if you took all the, how do you draw that little thing? If you took all the premiums from that and added it up, let's say over my life it ends up being, I don't know, I don't want to do the math that. So let's say it's $15,000 or whatever it is, I don't know. If you added that up and you added up the total premiums paid here, it's going to be the same. It'll be exactly the same. It's just I started small here, ended up getting to the point where I was paying maybe $40, $45, $50, $55 a month. Here, where I was paying $7 here, but if you add it up over the whole time, it's going to be $15,000 total. It'd probably be more than that in our little example, but just as an example, okay, or whatever it is, it might be less. But then if you add it up here, it's going to be the same. But just to teach the principle, the cost of being covered for 30 years for the risk of a 35-year-old is the same whether I get a level policy or whether I get annual renewable term. But then again, to keep payments the same, what they do is they just add up this, divide by 30 years, and then that's what my fixed payment is. Okay? But annual renewable term would start low and increase from there. So there may be several reasons why somebody might want to do that, especially if they can add certain riders to it that allow them to convert it potentially to coverage where they don't have to prove insurability or things like that. Or they are in a situation where they need the insurance, but they just, I mean, as much as $25 to $35 doesn't sound like that much, it may be that they're in a position that, you know, maybe that $25 to $35 they can't afford, or maybe they need a lot more coverage for just a short period of time, maybe during some project or some open enrollment situation where they just need the coverage for now. They don't want to pay for the cost of a 30-year, so they just get an annual renewable term to cover that difference. But one thing to know and note is that all life insurance, not some, not this one or just that one, every single type of life insurance is calculated on annual renewable term. And so if somebody's saying, well, you know, whole life is more expensive, universal life is more expensive, term is the way to go, blah, 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 and they're super passionate about it, they're all calculated the same. They may be talking about maybe some administrative fees or something where if someone was to hold a whole life policy their entire life, yes, that would cost more than getting a temporary term policy for a little while. But if someone's planning on staying insured, let's say their entire life, and I'm not saying you should or shouldn't do that, I'm just saying if that was the plan, it is less expensive to get the permanent policy than it is to get a 30-year term, renew it for 30 years, renew it for 30 years, or let it, you know, the term period expire and let it turn into a renewable from that point. The cost of insurance is the cost of insurance. And depending on how long you want to stay insured and what type you get and how early you get it and what your health rating is, and all of those things are factors. But all life insurance is annual renewable term. How they calculate spreading out when you pay that, that's going to be up to the insurance company. Okay? So now let's talk about riders. All the different types of riders that can be on a life insurance policy, the most common ones, there's 10 of them. So let's talk about all 10. Number one, first of all, what is a rider? If I have a life insurance policy, a rider is going to be something that's added to the policy. So you imagine, as it says in the life insurance study material, if you ever go get a life insurance license, is it gives an example, or at least the book that I used in 2005, said imagine the horse being the policy, and the horse can run by itself, but a rider is like a rider on a horse. You just stick the rider on the horse, and it's just something additional on top of the policy. Kind of a silly example, but hey, I've never forgotten it. So it's a rider that we just add to a base policy that already exists. So we might have a term policy, we might have a whole life policy, we might have universal life, index, variable. There's a whole bunch of different ones, but then these are the types of riders that can be added to these base policies. So the first one is going to be an additional insured rider. Okay, most commonly a spousal rider. So I have a policy on me, and let's say, two examples, I have a business partner, we want to just have one policy, but both of us on the same policy. Or I have a spouse, or, well, I have a spouse, and so I have the base policy, I get my spouse on there as a rider, and a lot of the time, before multi-policy discounts and waiver of policy fees and things like that, people would recommend, insurance agents would recommend always doing a spousal rider over getting one on the husband, one on the wife, because if they did one on the husband, one on the wife, both would be charged a policy fee, and so then you're paying two policy fees. Where now, if you do two insurance policies with the same company, they'll waive the policy fee on the second one. In most cases, I'm not going to say that every single company is going to do that, but they'll waive that policy fee because you have a multi-policy discount with the same company. So basically what that is the cost is not less. They do the underwriting the same. So if I was to get a $250,000 policy on me and a $250,000 policy on my wife, the only thing that would make it less expensive is if they waive the policy fee. It's not less expensive for her to be a rider on mine than it is to just get a separate policy with the same company if they're waiving the policy fee. Okay, but then we can just have one policy. So you could think, well, the benefit to that is you've got one policy, one payment. The downside to that is if we have one policy, I'm insured, she's insured, what happens if we get divorced? And I've run into that, not me personally, but I've run into people that's happened. I'm not getting divorced, but running into people that has happened, and it's not impossible, but it's just a little bit of a challenge sometimes to separate those two sometimes. So that's number one, is an additional insured rider. Number two is a child rider. Okay, child rider, they are sold in units, 1, 2, 3, 5, 10 units is what they call it. Each unit represents $1,000. So let's say I was to get a 10 unit child rider, that equals $10,000 of coverage for every child I have, regardless of how many I have, but there's only one price. So, for example, 10 would be somewhere in the range of $7 a month. And I pay $7 per month, regardless of how many kids I have. If I have one kid, I pay $7 a month. If I have 4 kids, I pay $7 a month total, not $7 per child, and it covers all of them for $10,000. And that's a child rider. Child riders usually last until about the child's 21 years old. At that point, the child can either take this coverage to their own policy without having to prove insurability, They probably should, because a juvenile rating is usually more expensive than if you can get a preferred or better rating, sometimes even standard. So they can usually take that with them and continue to pay for it themselves. And most of the time, it has something like a 5 times multiplier guaranteed insurability, that if they get to 21 and want to take over the policy themselves, they can take that $10,000. It automatically converts to $50,000 without having to prove insurability. So child onset diabetes or things like that, that could be helpful to have a child rider that could be converted to their own policy. If one of the children were to pass away, heaven forbid, that would be terrible. But if that were to happen, then the $10,000 goes to the owners of the policy, probably the parents, to burial, etc. But that doesn't affect the coverage on the other kids. Okay, so that's number 2. Number 3 is going to be a waiver of premium rider. What a waiver of premium rider is I'm paying for my term insurance. I get sick. I go into the hospital. Because I have the waiver of premium rider, while I'm terminally ill, they would waive me having to pay my premium. So if my premium is $30 a month, $40 a month, $100 a month, whatever it is, while I'm terminally ill, they'll waive my premium. I don't have to pay for my premium, but I stay insured. Okay, all riders, almost all riders, and I'll tell you some don't, but almost all riders come at an additional cost. But sometimes if you were to do those separately, it's more expensive to do them separately than it is to add them on a rider in some cases, not all cases, but in some cases. Okay, so that's waiver of premium. This one is an additional cost. This one's an additional cost. Again, depending on how the underwriting goes, doing an additional insured is obviously an additional cost by adding them to the policy, but it's not necessarily less expensive to add them than it is to do it separately. Okay, number 4, disability. The disability rider. This is one where if I were to get a disability policy separately from my life insurance, it would be more expensive as a standalone disability policy in almost every case than it would be to add it as a rider. So what does that do? Disability insurance is usually purchased based on the monthly benefit that I'll receive if I were to become disabled. So I have my $250,000 policy for life insurance. If I die, my beneficiaries get that. If I live and I become disabled, then I've added a rider to it, let's say, that gives my spouse a $4,000 per month benefit if I were to become disabled. So I become disabled, we send in the little letter, and the life insurance company now starts sending me and my wife $4,000 a month for a certain period of time that I've elected. And obviously the higher this benefit is and the higher the time that I ask for that to last, the more expensive that rider is going to be. That's a disability rider. Number 5 is going to be the terminal illness, and again, this one comes at an additional cost. Terminal illness rider, or the accelerated death benefit. This one is free. This one does not come at an additional cost. So how does this one work? Well, it kind of explains it in bold. The terminal illness accelerated death benefit means they accelerate my death benefit, meaning I die faster. Just kidding. But if I become terminally ill, instead of waiting until I die to pay out the death benefit, I can send in the doctor's note that says Adam has a terminal illness, and they will start giving me certain percentages of my death benefit while I'm alive so that I can pay for medical expenses or other things. Okay, something similar to that but different is you have chronic care and critical care riders. And so terminal illness means you're going to die in 12 months and you get a letter from the doctor that says you're going to die in 12 months. Chronic is going to cover specific diseases or illnesses. Critical is going to cover specific diseases and conditions and things like that, where the death benefit, say it's $250,000, will now turn into money that can be used for paying bills, paying medical expenses, paying whatever, because I've been diagnosed with whatever the conditions are inside of each of those. Okay? So, but the terminal illness, accelerated death benefit, that one is free. Chronic and critical care riders are not necessarily going to be free, so that's number 6 and number 7. Okay, which messes up my little notes on the board because a lot of the time people lump 6 and 7 into number 5, but because they're not, they can be separate. There's going to actually be 12 riders that we'll talk about. Okay, number 8 is going to be the guaranteed insurability rider. Okay, what does that mean? Let's say I'm 20 and I just got married and we just found out we're about to have a baby. I can't afford a $500,000 policy, but I eventually want a $500,000 policy potentially, but I can only afford $150,000 right now. I could get a $150,000 life policy with a guaranteed insurability rider, which gives me the provisions that within a certain amount of time, I can add additional coverage to my policy without having to go through any medical examination, so that I can add insurance later without having to worry about having proof of qualification. So obviously I would have to pay a little bit more initially, even though it's a smaller policy. I pay a little tiny bit more than the cost of just a traditional $150,000 term because I have an additional option and it's a rider. So that one comes as an additional cost as well as these two. Okay, next one is going to be an accidental death and dismemberment. And by the way, before I forget, you can go in and all you have to do is Google chronic illnesses and it'll give you the list that this one would cover. Critical illnesses will give you the list that this one will cover. Okay? Accidental death and dismemberment, or sometimes called double indemnity, is an accidental death and dismemberment policy added to a life insurance policy. So if I die, it pays out the death benefit. If I die specifically in an accident that's covered as one of the accidental death and dismemberment conditions, that if I die, that it will be considered an accident, which is kind of funny. Rarely would I say that people die on purpose, but it's just called accidental death and dismemberment. Yes, some people do die on purpose. That's not what we're talking about. So what could happen is if I have a $250,000 life policy with a $250,000 accidental death and dismemberment policy, the accidental death and dismemberment is a couple bucks, and the life insurance portion is, say, 25 or 35. If I was to die in an accident, my wife would get $500,000, or that's why they call it a double indemnity. If I were to die in an accident, the death benefit's double. If I were to die from getting cancer and a slow death over 10 years or something like that, then it's just the life insurance side that pays out, but it doubles as two policies. Okay. Number 10 is going to be a pretty unique one called an income rider. So there's income riders on like annuities and stuff, but this is an income rider on life insurance. So what it can be is almost like a built-in trust or built-in will inside of a life insurance policy that I can tell the insurance company, when I die, I don't want you to pay out the whole lump sum death benefit to my heirs. I want you to pay it out over time. So what I could do is if I have my $250,000 policy, I could tell them, I want you to pay out $25,000 a year for 10 years. Or I want it to be, a lump sum up front of $10,000 to each of my kids, and then $1,000 a month until the money runs out as a death benefit. And so, $10,000 to each kid plus $20,000 to bury me, and then $1,000 a month until it runs out. So you can specify in the death benefit payout how it's paid out, and that is an additional cost to have that as a rider, as is the A, B, and D. Okay, number 11. Do we still fit on the board? Yes. Okay, so number 11 is going to be a long-term care rider, which we covered. If you're watching these sequentially, we covered in a previous lesson. And then there's also, which comes with an additional cost, and then number 12 is going to be a return of premium rider, which we also covered in a previous lesson. So those are, see you later, Marker. Those are the riders that can be added to a life insurance policy. So as you can see, when it comes to life insurance planning, a lot of the time it turns into life, not just life insurance planning, but just insurance planning in general that could cover a whole bunch of different situations. And to be totally honest, that's what kind of sucks about insurance altogether. There are so many what-ifs that, I mean, could all of these things happen? Could my kids die? Could I need a waiver of premium? Could I get a chronic illness? Could I want more insurance later? Could I die accidentally? Could I want to pay out the death benefit as a payment instead of a big lump sum up front? Actually, I lied. This one does not cost anything. The income rider, doesn't matter to the insurance company how they pay it out. They're going to pay it out if you die within the terms of the contract, right? So there's no cost to the income rider, but the long-term care and the return premium there is. But all of these things could happen, but then the thing that sucks about it is all these things could also not happen. And so you think about it, if I were to get just a regular life insurance policy and it's $35 a month, if I add all of these riders to it, I might be looking at $200 a month. And could all these things happen? Yes, but they could also not happen. And so that's the lame thing about insurance, really, to be totally honest, is that we don't know what's going to happen. But we just try to cover that risk as much as we can. We do what we feel is right for us and our family, and we hope, and again, that's kind of a lame word to use, but we hope that we've covered all the necessary bases as our foundation of our plan to make sure that we're protected from loss of income, loss of life, loss of the ability to work, and then just save and save and save a ton of money to hopefully get to the point where we are self-insured. So thank you for joining us on the Impact School of Money, where we give you education on how money works, and we're not trying to sell you anything. We're trying to educate you on how things work, and so we don't charge a fee for this. We're not going to pester you forever about your money, but here is the fee that I think should just be an understood thing, but I think sometimes we just need to clarify it, is if you really see value in this, the fee that we ask is bring us somebody. Bring somebody to the Impact School of Money. Share the education. We don't do advertising specific to the Impact School of Money as far as like sponsors and things like that, but do we think that by providing education that it will come around and help be able to help families, and that our company will make money doing it? Probably, eventually, but that's not the, hey, buy today, buy today, buy today. We want to provide so much education and so much value for free that if people want to learn more, they can come and talk to us. So thank you again for joining us in the Impact School of Money, where our mission is to help people and change the way that people are educated about money. My name is Adam Davis. Thank you again for joining us. Have an awesome day. Class dismissed.